Hey guys, Andy here. Hey, so is your IRA an IOU to the IRS? If you have been saving money and you're approaching retirement and you have your retirement funds in an IRA or a 401k or a 403b pension, something where you haven't paid tax and you would like to build your dream retirement lifestyle with the investments that you currently have, then this is going to be one of the most important videos that you watch all year for 2024. Super important. Here's why. Millions of Americans aren't confident about their ability to retire. Yet tons and tons of clients and meetings with folks that are very curious as to whether or not they're going to have enough. Will it last long enough? Can I take vacations? Can I keep doing the things that I love doing? And am I going to run out of money? Is the basic question. So in just a second, you're going to discover all the things you need to know. And this is going to allow you to build the life that you've always dreamed of living during retirement. Plus, in this video, you're going to discover how to get personal help and guidance along the way so that you can make achieving your goal of a successful retirement a reality. And this is completely complimentary. Anything that we offer you here is free, and we want to meet with you. We want you to have financial success so that in the future, we can also work with you on different projects, helping you manage your investments and things like that. My name is Andy Rogers. I'm a certified financial planner. I've been in this business for over 20 years, helping people just like you plan for retirement and successfully retire and still be retired 20 years later, living the lifestyle that they want to live. Many times me having to tell them, maybe you should be spending some more money. So if they don't have to give up their hobbies, they don't have to say no to the vacations, they don't have to be stressed out if they're going to have enough to keep them going. And I'd love to help you too. But first, let's talk about important things that you need to know. So if you want to build a lifestyle and the dream of retirement that you've always been thinking of, we are in a very unique time right now in this country's history where our taxes are super low. And at the same time, the federal debt is over $32 trillion and continues to grow year over year. So who do you think the government's going to ask to pay this debt for them? I think you know the answer. And this kind of comes around to the point where we talk about your retirement accounts as a way that the IRS and the government plans to fund the deficit and the debt that they've taken on over time. So we want to teach you how to go about fixing that and what you can do to be proactive about your situation while tax rates are still low, right? So ask yourself this question. What tax reduction strategies has your financial advisor or your tax preparer been helping you implement, or what are they suggesting for you? And a lot of times we have an accountant and a CPA or a bookkeeper and a financial planner. Are they proactively helping you plan for your taxes 10, 15, 20 years down the road by taking action now to get ahead of what could be happening later down the road? Far too often, people seeking out my help have told me that their advisor hasn't offered any sort of tax planning advice. And a lot of times as a CFP or a financial planner, we struggle to, look forward and help our clients with taxes. And we want to stop that right now. We want to take advantage of the loopholes that are currently open and the things that we can be doing today that can help you save tens, not hundreds of thousands of dollars down the road. So if you're looking to fund the lifestyle you want, and the more you pay in taxes, the less you have left over to spend, right? So first of all, do you know the rules of the game? What are the rules of these pre-tax IRAs? What about your 401k? What about your 403b? You've been putting money into them this long. Set it and forget it has worked up until now. But what can you do proactively every year going forward to save yourself money on taxes 20, 30 years from now? What tax laws apply to your situation? When you're required to start taking money out of these accounts, are you going to know when that is? Are you going to be facing a penalty even if you don't take money out of these accounts? Some people just don't know about these things. The penalty is severe, 50% on required minimum distributions. Do you know what age that happens? So if you don't, stay tuned. The government is going to require you to start taking money out at a certain age. It's called a required minimum distribution. Most of you know about this, but some of you have no idea. Do you know what percentage you're going to be required to withdraw and why that amount increases over time as you get older? Why doesn't the IRS let you take these distributions and just roll them into a tax-free Roth IRA? These are all great questions. And if you don't know the answers, that's what we're here for. We want to help you navigate some of these rules so that you can take advantage of them today. All these factors are going to serve to increase the IOU that you have currently to the IRS. There's only two tax breaks that the IRS is ever going to give you at one time. There's 3 tax breaks altogether, and you want to know which 2 you're trying to navigate. So in September 2nd, 1974, it was an important date. This was the date that IRAs were born. And although the law was passed on that date, much thought was given to how these accounts would be taxed. You'll see that laws were put into place to allow the government to cash in on your IRA. And note that IRAs impact each of us differently depending on our net worth. So savers and people that have done a really good job putting money into these accounts, as well as high income earners, these people are penalized. And for these reasons, lower and moderate income earners, most likely they're going to have a much more favorable outcome. So if you are a high income earner or you have a high net worth, this is for you. This is really going to help you along the way. Like I said, save tens, possibly hundreds of thousands of dollars in the future. In fact, most Americans' IRAs are an efficient tax saving vehicle. But large IRA owners, people with $1 million plus, might find that they're going to pay more in taxes during their lifetime and in the afterlife than they ever even withdraw from their IRAs. So yes, they're going to even tax your beneficiaries in the future once you're no longer here. So anything we can do to get ahead of that now, we want to be doing that. Savers are at a disadvantage on several fronts. They are the exception. Most media coverage on this topic is directed towards the non-saver. They make it sound like those people who somehow are just going to try and survive in retirement, that they want to focus on that because it's sad. It's news. It keeps you tuned in through the commercials. But the fact is that it gets down to this. You had a plan to save and it worked. In the game of life, you're nearing retirement and you basically are at halftime right now. How you play the second half will determine whether or not you're going to win or lose. The saving portion of your plan is complete, but what about your exit strategy? This is where the rubber meets the road. What is needed at this time is not a better investment. What you need is knowledge. The knowledge to enable you to keep more of what is already yours. I'm going to provide you a simple example of how your IRA is taxed, and you'll see how the lack of knowledge leads to making irreconcilable mistakes. The purpose of this example is to demonstrate that this does not have to be you. The average person cannot do this on their own. You need the help of a professional with expertise in this area. Congress had a choice in establishing the way the IRAs are taxed. 1, lowest tax rate of 0. 2, a tax advantage, tax structured capital gain. Or 3, the highest tax rate in the land, ordinary income tax rates. You guessed it, they chose the highest tax rate, ordinary income tax rates are what you're taxed at when you take money out of an IRA, 401k, or a 403b. They had another decision to make. How was your IRA going to be taxed at your death? Would it receive the same tax treatment as non-retirement savings, which is not taxed at death? Again, the answer is no. At death, IRA accounts are subject to income in respect to the decedent. Income on the person that's already gone. Income a person would have received had they not died. So when I look at how your IRA is structured, it seems that Congress studied how consumers spend their retirement savings. In fact, the General Accounting Office did just that. Now I ask myself, why would Congress want you to know that? Why would they want to know how we spend our retirement accounts? Here's what the General Accounting Office found. Retirees share a common fear. They're afraid of outliving their money, and this affects how they spend it. Upon retirement, most of us watch every penny. If we can live off our Social Security and non-retirement accounts, we will, but we won't touch our retirement accounts for two reasons. First, we're afraid of outliving our savings, and second, we don't want to pay extra taxes. Here's one of the most remarkable, startling things I've learned about IRAs. It seems that Congress took the General Accounting Office report and structured IRAs so that your natural aversion to behavior towards taxing and taxation is going to lead you unknowingly into paying the highest tax rate down the road. They are counting on the fact that you're going to do nothing and you're going to sit there on those retirement accounts and not spend money in your early retirement years, especially. These are distribution rules. And yeah, that's right. There are rules as to when you must take money out and be taxed at the highest ordinary income tax rate. So consider what most people do. So far, you've discovered upon retirement, we touch as little of our retirement savings as possible. We scrimp and save and protect our savings and seemingly save on taxation, right? While we do this, our tax bill within our IRA is growing exponentially. Consider a $1 million IRA has about $400,000 of tax that is owed to the IRS. Deferred, but nonetheless owed. Compounded at 7.2%, your tax accrues as followed. In 10 years, that would be $800,000 in tax. In 20 years, $1.6 million in tax. In 30 years, $3.2 million in tax. That's just on a $1 million IRA. So if you do what your friends and neighbors do, you may be in the same position as they find themselves, paying more than is necessary. Your IRA is subject to 6 levels of taxation. So the RMD, the required minimum distribution, which is going to be taxed every year as the money's coming out of the IRA at the highest tax rate based on your income tax bracket, right? So once that money's coming out, your effective tax rate on all dollars on your tax return is elevated by your RMD. 3, the RMD is invested. So let's say you take it out of the IRA. Now you put it in your bank. Now that money, if you earn interest on that money in the bank, that money is going to be taxed. The interest on your savings is going to be taxed. The RMD also can raise taxes on your Social Security. The RMD can also contribute to the cost of your Medicare. IRMA taxes. So if you haven't looked up IRMA, IRMMA. So it's a tax on Medicare for people that have high RMD amounts. And income in respect to a decedent on the balance of your IRA, once you pass away and it gets passed on to the kids or to your beneficiaries, you're going to get that money's going to be taxed again. So again, there's a ton of things we can do to plan to get around some of this stuff. And a lot of that is what we can share with you if we decide to get together and at least have a meeting about your situation. So the biggest culprit to your growing tax liability is obviously your RMD. And the RMD begins at age 73. It's calculated by a number that increases, and that percentage can increase every year. Then on January 1st, when it resets, the value of your account, the RMD gets recalculated based on the new account value. So if your balance of your IRA is growing every year, then so is your RMD. And so here's an example of what some of these RMDs could possibly look like. So let's take a 58-year-old person with an IRA. They have $1 million in the IRA. Here's what some of these numbers can look like. So if you have $1 million in an IRA at age 58, and we're growing that money at 6 to 7%, it's going to double in 10 years. So you're going to have basically $2 million by the time you're 73. If you have a couple $1 million in an IRA, your RMD is going to be about $100,000. So let's say you and your wife have taxes, or you and your spouse are getting, $100,000 worth of income, and you have a pension, and you have Social Security, and you add all those numbers together, pretty soon you're in one of the highest tax brackets available. It just happens to be right now, in this point in history, our tax rates are pretty low. So imagine what this extra income is going to do to your tax bracket on your tax return. Every year it's going to raise the taxes on every dollar every year for the rest of your life. So if you use the plan that the IRS has laid out for you, you're going to be sitting in the highest tax bracket possible for every year for the next 30 years. So what can you do? What should you possibly consider doing something different than what you've been doing? Set it and forget it, or, working with a H&R Block or TurboTax and just kind of doing it yourself with no real forward-looking tax planning. I think you know the answer to that. So to put yourself in a better position to keep more of your hard-earned money that you've saved, you have to start taking a disciplined, scientific approach. You're going to find that there's few people in the country that have a long-term, disciplined planning approach around tax planning. Tax planning should be done based on math. This approach doesn't work if you're making assumptions and you're trading off emotions. That doesn't work in this situation. Taxes are real. The IRS knows it. That's what the IRS is counting on. And this is when it pays off to have a mathematical, structured approach to what you're doing. The math on this stuff matters. It's just math. And I can show you what it looks like specifically for you. And many times people are just like, Andy, but it just feels bad to have to pay some tax up front. I don't like paying taxes now. Well, you don't like paying taxes now, you're really not going to like it down the road when you turn 73. So what you need now is an exit strategy. So you can do this by creating several different what if scenarios. We can create some models. We can compare and contrast them to each other based on different outcomes. And that way, when it takes some time and it takes a little bit of extra expertise, but once you have an answer, the approach is very straightforward. It's very systematic, and it's based on math. So the solution is to try and move money from accounts that are going to get taxed all over the place to ones that are only going to get taxed once. Like I said, there's only 3 tax breaks that the IRS is ever going to give you, and they're never going to give you all 3. So your job is to understand which tools you can use to get as many tax breaks as possible going forward, right? So here's the most effective tools. 1, the Roth IRA. So we all know what a Roth IRA is. This is a retirement account. It's different than a conventional IRA in the fact that you've already paid taxes on the Roth IRA money. It's growing tax-free. It's not subject to the RMD at age 73. If you pass away and people inherit it, they don't have to pay taxes on this money. Um, there are qualification rules for putting money into a Roth IRA, and we can go over those, on a call that's specific for you. But there's no restriction right now on converting money from your IRA in your 401k or your 403b, converting that money into a Roth IRA, paying some tax on it now while tax brackets are low, and doing that now and doing it every year up until you turn 73. So the other tool that we really like is insurance. So there's a little known loophole open still, that is insurance. If you have money in an insurance policy, the IRS, they don't tax it as it grows, and you can take money out of the insurance policy tax-free. So you don't have to pay tax on it as income if it's coming out of an insurance policy. So these are just things that we can use, things that we can go over on a call that, if we take a look at your situation, this is just a typical illustration that we would run for a client. This client happens to be 58 years old. They want to retire at age 65. So we got about 7 years to go. They want to start taking income at age 65, and they expect on taking about $114,000 a year in income. The problem is they got 1.7 million in their IRA, and their Social Security as a couple is going to be like 70 grand on top of that. So if you do the math on this thing, again, it's just math. My initial analysis on this particular situation is pretty significant. So this client was set to have excess cash flow of $3.2 million that they were going to have to take out due to their RMDs over the course of their lifetime. So, here's somebody with a $1.7 million IRA. All of a sudden, they're forced to take $3.2 million out of their retirement accounts and pay tax on that over time. So this excess cash flow would be taxed at the client's, ordinary income tax rate. All the excess cash flow on everything gets raised on every tax return. So it becomes pretty ugly pretty quick at age 73, and we just want to help you get ahead of that. So this is the clearest indicator that the account owner is in a position to lower long-term taxes paid with just a simple, straightforward math-based planning solution. So in this case, we would illustrate doing Roth conversions, converting money from the Roth or from the IRA and taking money out of the IRA, paying some tax on it, and investing that in the Roth IRA where it's going to be tax-free for the rest of their lives. So in this case, here's another illustration of what we did for this particular, and this is just a case study. So it's not a real client, but this is what we do for our clients. Is in this case study, we illustrate doing a Roth conversion every year for the next 5 years by taking money out of the IRA and putting it into a Roth, pay some tax on it now. And we do $2,000 a year for 5 years. So we pay some tax. And then this would generate a tax due each year of about 60 grand. So I know that's a big tax bill, but over the course of this person's lifetime, if they live to be 90 years old, it could have saved them $1.8 million in taxes. So pay a little bit of tax up front to save 1.8 million over the lifetime of the plan. Right. And there's just not a lot of people telling you this stuff. And the IRS hopes that you don't do anything. Right. That's what the IRS is hoping for. So anyways, so far you've discovered to build a successful retirement and live the life you want to live without having to give up the parts of your life that you enjoy. It's crucial to understand one thing. You can build a successful retirement without giving up the hobbies, without saying no to vacations, doing all this stuff. You can, not have to be stressed out that you don't have enough money. You can know for sure that you have a plan of what you're going to be doing every year. And because you're watching this video, it shows that you're serious about building a successful retirement plan. I know you stuck with me this long for a reason. So I personally like to help you create a strategic plan to build that retirement plan out for you. fitting it exactly to your situation for the life that you want to live, for what you want to get out of your life, possibly even for generations to come. So there's no obligation to meet with myself or somebody on my team. Take 30 to 45 minutes, just a Zoom call. We can, I've been doing this for years. My team and I have gotten really good at finding opportunities that maybe other advisors haven't found. Maybe your CPA might have missed it, or, we enjoy working with existing CPAs. So if you have a CPA and you really trust them and you like them, but they just haven't done any proactive tax planning for you, we're happy to work together with those CPAs to get together and build a plan for you that's going to help you be in a much better place 10, 20, 30 years from now than if you didn't do anything. And if you just sat on your hands like the IRS is hoping that you do. So I'll do most of the heavy lifting myself. Somebody on my team is going to show you all of the key considerations you need to make to know for certain that you're not going to get blindsided during retirement. So at the end of this initial planning session, one of two things will happen. One, you'll love the plan. You'll decide to implement it, and you can do that on your own if you want. And if that's the case, I wish you the best of luck. You can, thank me for meeting with me, and I'll thank you for meeting with me, and you can walk on your way and have a good plan in place. Or second, you love the plan and you ask to become a client, and we can personally help you implement the plan and do that every year for the rest of your life. So to take advantage of this opportunity, I want you to do it now. It's really that simple. There's no catch. So think about this. If you invest 45, 60 minutes of your time, you get some helpful information, you walk away with some keys that you may not have had before, great. The best that can happen is if you work with myself, somebody on my team, and we can build your dream retirement, you end up crushing your financial goals, and you end up keeping more of the hard-earned money that you saved, and you keep it out of the hands of the IRS. So here's how it works. First, we understand exactly what type of lifestyle you want to live. We want to know what that looks like for you. Then we're going to take a close look at your financial situation, look at your income, look at your net worth. We're going to take a snapshot of where you are today, talk about where you want to be, and we're going to look at all those assets and see what we have to work with. Finally, we can match up those goals with what you've got going on and build a plan to fill the gap there. So by the time we're done talking, you'll have this roadmap, a retirement readiness roadmap in place. It's going to act as a guide on how you can maximize your current investments to fund this lifestyle, minimize taxes, reduce risk, all that good stuff, all just from one call. So there's no obligation for this. So why am I offering this to you? Two reasons. One, I really like this stuff. I'm passionate about it. I've been doing it for 20 years. My grandpa was my mentor, and he didn't have a plan, and I'm looking around, and there's a lot of people out there without plans. They don't teach this stuff in high school. They don't teach it in college, and I just happen to be really good at it. It's what I do best. Makes me happy to see my clients successful. Makes me happy when I have to tell somebody, hey, you should probably spend some more money, or we need to take some money out now so you can save some money on taxes, maybe even pay more taxes now so that you can save money on taxes down the road. Start to live the lifestyle that you deserve to live. And second, this is how I attract clients. Used to get together, in networking groups in person, but now I'm using, the internet and video and conferencing softwares and that sort of stuff to work. So you can get together in person, still have people coming into my office and meeting with me in person. I'm here in Seattle, Washington, but you can be anywhere throughout the country at this point. So assuming you're happy and you want me to implement, or somebody on my team to implement the plan for you, I might invite you to become a client. If you decide to not become a client, that's fine too. There's no pressure, no sales pitch. I'm a professional, been doing this for 20 years. So again, this isn't for everybody. And I only work with who I enjoy working with. So I'm very selective about who I work with, make sure that people on my team only work with good clients that are positive and that, take this stuff seriously, but like to have fun. And so, here's some of the things that I enjoy about clients. And if you fit this, maybe it's a good fit. So first of all, you have to be lifestyle focused. I'm interested in figuring out, what you're all about, what you like to do, what you don't like to do. Um, again, this is a huge part of this for me is to see my client's lifestyle and help them, do more of what they like. It's all about lifestyle, not just about the money. Secondly, you need to be a few years out from retirement if you're not retired already. So it's okay if you're already retired. If you're a few years out, that's great. 5 years out, that's fine. A lot of times the strategies that we implement are most beneficial for people that are close to or just nearing retirement or recently retired. If that's not you, I do have other folks on my team that you can work with. But specifically the strategies I'm talking about here are good for pre-retirees. Third, you have to have at least 250,000 in investable assets. So again, this doesn't make sense for people that have less than 250,000. It's probably more of a burden for them than anything else. And again, we find that we can add the most value to our clients when they have at least $250,000 and over, preferably 500,000, maybe even 1 million. So, again, fourth, you need to be willing to take advice and listen. So not just talking to hear myself talk. We give advice, specific advice, and we help people implement. So if you're not good at taking advice, you just want to take this stuff and run, this really isn't for you. I mean, obviously I can sit there and give you some free advice, but I'm busy. I got a lot of clients, and I'm better off working with them and adding value to their lives. So if you think you know it all, great. I'm glad that you know it all. We like people that know it all. And, if you want a job, great. You can join my team and, work for us possibly. So here's what you can do next. Assuming that you meet all these criteria, I'm happy to set some time aside for you or somebody on my team. The process for this is as follows. First, you'll be taken to a little application where you fill out an application. We want to make sure that, none of these are hard questions. It's just we want to make sure that you're a good fit. And then, we're going to get some information from you in advance so that our time together is productive as possible. So then once you complete the application, you'll be taken to my calendar. You go ahead and plug in a time that works for you. Like I said, it's 45 to 50 minutes. This is when we're going to start to work together. You're going to get us some information. We'll process the information. We'll make sure that the meeting is very productive. Talk about your goals, talk about your dreams, figure out how we're going to improve your tax situation. And if at the end of the meeting you decide you want to become a client, great. We both agree it's a good fit. Fine, great. We can discuss that. And again, if you decide that you don't want to become a client, that's fine as well. You can walk away with everything we talked about. No harm, no foul. But please understand, time is of the essence. Like we talked about earlier, I only have a few number of these complimentary sessions. The IRS rates are super low right now, and we believe that's going to go away. I think it sunsets in 2025. Things are going to go back to the way they were before. So we want to take advantage of these things in the next couple of years. I spend most of my time working with existing clients, getting them results. So, again, if you book a meeting, show up. If you cancel, then that's it. You don't get another shot. So if you feel this is right for you, go ahead and click the button below. It's just a no nonsense application. I'm a no nonsense kind of guy. Again, this is math, science. We're working without emotion to get you the best results that we can on paper and doing that year over year over year. So again, schedule some time to talk with myself, someone on my team. This is an opportunity to get advice from, somebody who's been doing this for 20 years and an expertise, that probably is not found. It's pretty rare in this industry. So anyways, Build yourself a successful retirement based around your personal goals and dreams. No obligation. If this sounds good, click the link below and, fill out the application and get on my calendar. Once again, I'm Andy. Look forward to seeing you on the inside. Oh yeah, meetings are accepted first come, first serve basis. Again, thanks again for staying to the end. Go ahead and click the link below while it's fresh in your mind. I look forward to working with you.